You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
Hi, I'm Kristen Hallam, content strategist at S&P Global Market Intelligence, and your host for this episode of the Economics and Country Risk podcast. House prices experienced sharp increases in most developed economies during the last decade as record low interest rates supported demand for property. The tightening of global monetary conditions over the past year has driven a softening of house prices, which in some key markets are expected to decline in 2023 and 2024. The degree of impact, of course, varies by market. Joining me from S&P Global Market Intelligence to discuss the U.S., Canadian, and European housing markets are Patrick Newport, who works for our U.S. macroeconomics team and covers the housing market and international trade, Arlene Kish, Director of Canadian Macroeconomics, and Anya Hyman, a senior economist in the Europe economics team. Thanks for joining us today. So, Patrick, let's kick off our conversation with you. Can you give us an overview of what U.S. housing markets are looking like? Have prices bottomed out?
Sure. In about 2 minutes, let me talk about housing starts, home sales, and home prices. The single most important and probably the most important housing number that comes out every month is single-family permits. Single-family permits are well measured because they're based on actual counts. They're not affected much by seasonality or bad weather, and they're not subject to much revision, and they're available at the state, national, and local levels. But most important, they accurately point to where new single-family construction is heading over the next 9 months. Single-family permits are coming up a miserable year in which they fell for 11 straight months, but it's picked up in the last 3 months. They've grown 14% since January, and all 4 regions are seeing a rebound. So we're seeing a slight rebound in the new single-family construction market. The multifamily construction market, which makes up about a third of the housing market, remains surprisingly strong. Construction levels are right now we're at levels last seen in 1986, although this category is starting to slip because we've seen overbuilding and there are indications that rents may stall. It's likely headed from some hard times starting later this year. Home sales have also come off a miserable year. Over the last 12 months of last year, they fell by over 2 million. They've never fallen by that amount ever. That is unprecedented. But in the last 3 months, they've started to stabilize. Finally, home prices. This is a really tricky number to track and to understand, but home prices grew at over 20% rates from the start of the pandemic to the middle of last year. And then they just turned on a dime. They started to fall. From double-digit rates, they started to fall because of rising interest rates. But then, starting this year, again, they've started to pick up again. And so we're seeing home prices on average grow. And when I speak of home prices, I'm speaking of real home prices, prices adjusted for inflation, which is the way you should look at this.
So, Arlene, how does that compare with what you're seeing in Canada?
Canada's a mixed bag of activity. We noticed that for existing home prices, the composite price levels, they bottomed in February of this year, and we saw home prices averaging just over $708,000 here in Canada. That's about a 15% decline from the very top of the market back in February of 2022. Now, some forecasters elsewhere, they were anticipating a much sharper decline, closer to 25%. So thank goodness that never actually materialized, because that would really impact wealth over there and consumer confidence. A couple months ago, we saw that prices, they've climbed already 2.2% from the bottom of the market. Toronto is driving that recovery, but we're also seeing home prices in Vancouver and Montreal. They're also gaining. Saskatchewan and places like Alberta, they have yet to see any kind of shift in home prices going on there. Quebec's housing market, it is a bit different. We know that the declines are pretty much stable, and that's because of pretty much what's happening in Montreal. And Atlantic Canada, that seems to be a bit of a mixed bag of activity there as well. Part of that's because of shifts in demographics. Some places there are still declines, but places like, for example, Newfoundland, for home prices never declined on an annual basis. So we always say there's never one complete home housing market. That's definitely true in Canada as well. Things seem to be turning around, but again, it's not happening everywhere across Canada.
That's a good point that you made there, Arlene, about how housing markets aren't homogenous. And on that note, Anya, Europe certainly isn't one homogenous market in any sense, really, particularly in housing. But could you maybe focus on a couple of noteworthy markets in the region and tell us what's happening there with prices?
Yeah, sure. Generally, prices in Western Europe have begun falling. So the fourth quarter, owner-occupier existing housing prices in the Eurozone were down 1.2% on a quarterly basis. And the downturn was quite widespread. We had 8 countries recording quarterly declines, and momentum is really slowing in all of the other economies there. I think the key point to highlight is that we expect the prices to fall further because we still expect the ECB to hike a bit more. Also, there is a bit of a lag of the transmission from monetary policy into house prices. Overall, roughly in the Eurozone, we expect price decreases by around 10% overall from their peak. But yeah, this is going to happen gradually over around a 2-year period. There's not going to be some sudden crash, and prices should stay above pre-pandemic levels. So the speed and intensity of this correction in Western European housing markets will depend on the imbalances that accumulated in the last decade. So where prices rose more sharply, where prices rose in excess of fundamentals such as household incomes, and where house price growth was accompanied by very strong debt growth in the household sector, those are the countries really that are most vulnerable. Plus, there's also the fact that in some countries, variable mortgage rates are quite prevalent. So those are also obviously much more exposed. And on that note, I might talk a little bit about Sweden. So Sweden was essentially the canary in the coal mine. House prices started decreasing last year pretty much as soon as the Riksbank, which is the Swedish central bank, as soon as they started hiking the interest rates in April last year. By the end of last year, house prices had fallen around 15% already from their peak, and we expect an overall peak to trough fall of about 20%. So most of this fall has already happened, and we can see in monthly data that the prices are still declining, but at a much slower rate. Why are prices already down so much in Sweden? That is because Swedish households are amongst the highest indebted households in Europe, with residential outstanding loans of around 200% of their disposable income in 2021. You also have a high prevalence of variable mortgage rates. So around 80% of mortgages are due for renegotiation within the next 2 years. So people will have to refinance now with much higher rates. And that's why Sweden was the first market that started seeing house price declines.
Let's talk about interest rates a little bit more, because obviously that's one of the big drivers of housing markets. Let's maybe go back to you again, Patrick, and talk about interest rates in the US, obviously very closely watched. But how have the hikes in interest rates by the Fed impacting housing markets?
Well, of course, when interest rates shot up last year, it just had a devastating effect on the housing market. It's having an effect on house prices in a strange way. In the United States, the mortgage rates is now back near 7%. There are about 50 million mortgages outstanding today, and nearly every one of those mortgages is at rates under what they are right now. About 2/3 of them are under 4%. And because of this big difference between the rate at which someone bought their homes and the current mortgage rates, people are locked into their homes. Essentially, they can't move. If they move, they would have to trade up a mortgage rate of 4% for one that's close to 7%. And because of that, there are not a lot of homes on the market anymore. That there's been a big contraction in supply, and that's the reason that home prices have started to rise again. So on the one hand, mortgage rates went up and it killed demand, but right now the rise in mortgage rates is also killing supply. And so we have this tug of war between lower demand and lower supply that is driving house prices, which makes it very hard to predict where they're headed. Right now, they're moving horizontally.
Okay, and how have interest rates impacted the market in Canada, Arlene?
Very similar to what Patrick was just covering there. For example, so the Bank of Canada, back in March, it began its tightening cycle. There was a cumulative impact of 425 basis point rate in terms of rate hikes. Then when we see with the mortgage rates, in Canada, we didn't have that same cumulative impact. So, for example, Patrick was saying mortgage rates was at around over 7%. Right now, a conventional mortgage for a 5-year term, it's 6.49%. There was an accumulative impact of just over 200 basis points for hikes there. So mortgage rates didn't climb as fast or as high as the policy rate did. So therefore, that could have kept some of the steam going in Canada's housing market, where we didn't see a huge downturn. Prices were relatively cheaper for borrowing costs there. We do know that right now, mortgage rates have been pretty much steady since late October. So we know that even though the Bank of Canada kept hiking, mortgage rates were holding pretty steady for quite a long time now. And we know that, so for example, home prices where it's relatively cheaper, people were trying to find either if it was for investment purposes or whether it's just because of circumstances of shifting jobs or changing locations. Home prices that were relatively cheaper or more affordable in some other areas of Canada, say relative to Toronto, those markets held up pretty well. I'm expecting interest rates to start declining next year. So that's going to probably help spark the recovery even further going into 2024 with lower borrowing costs.
Anya, I know you already touched on interest rates, the variable mortgage rates. Anything more to add from a European perspective on interest rates?
The key thing is that Europe is roughly divided into, when you think about mortgage rate fixation periods. Countries like France, Germany, or the Netherlands, they operate mainly with mortgages with quite long fixed rates. The German average interest rate fixation period for a mortgage is 14 years. So if we think about it, someone who needs to refinance their mortgage now at a much higher interest rate, after those 14 years, will pretty much refinance it at just about the same rate that they got 14 years ago. So there's not really a big shock for them in that sense. While on the other hand, you have Southern European countries, Greece, Portugal, Spain, and Italy, where there's much higher prevalence of variable mortgages rates. So people are refinancing their mortgages there now, obviously feel the pain much quicker. But then those were also markets that have seen, most of them, relatively less strong house price growth in the past few years. And the housing markets are less overvalued than some of those in the Northern European countries. So affordability is a bit better.
It's time for people to think about buying that Italian villa. Is that what you're saying?
Yeah, essentially, now is a good time.
Okay. You heard it here. So let's talk about what's driving demand. Is it migration? Is it supply shortages? Is it demographics? Arlene, let's start with you this time.
The short answer to all that is yes. It is immigration, it is supply shortages, and it is demographics. Canada has the strongest population growth within this G7. Just from the past calendar year, we saw a record number growth level in a population just over 1 million. The vast majority of that growth was from international immigration, which is very different from the last time. Last time we saw those boosts in population back in the 1950s. So what's going on with that? Part of that immigration growth is because we have very friendly fiscal policy where we want to see a lot of people coming into Canada to address our labor shortages, which is not too different from the US. For example, to accommodate all these people into Canada, the federal government has made a declaration in their budget saying we're going to double the number of new homes built, and we want to have approximately 500,000 immigrants coming into Canada every year for the next 10 years. These are very aggressive targets, and a lot of that has to be settled. We have the national number. That number has to be divided amongst the different provinces, and then within the province, you have to have issues as to what regions or cities, metropolitans, are going to have to take their share of that pie as well. But again, when you come and look at supply shortages, it's just where you're going to build these new homes. You have issues like where in an area of Toronto, there's a parcel of land that was built as a green belt. There was promises from earlier governments that no homes were going to be built on that land. New government comes in, now parcels of land have been sold off to build new homes, but yet how those deals were made looks kind of questionable to some individuals. And so now all of that is being investigated, and that's kind of delaying building of any homes. So we're going to have a supply and demand imbalance right now going on for several years while all these issues are sorted out.
Interesting trends there. Let's talk about the US. What are the main factors driving demand there, Patrick?
One difference between the United States and Canada is that Canada welcomes new immigrants in, and the United States does not welcome most of the immigrants who are coming into this country, but still a lot of them come in. And every 10 years, when the census counts people, it finds out that there were a lot more immigrants had moved into the country than they had earlier thought. The demographics are a key driver. I think that the key to understanding demand is one number, the monthly mortgage payment, the amount that you pay on your mortgage every month. This is a number that the National Association of Realtors calculates in a formula, in an affordability formula. And that monthly mortgage payment essentially doubled between the beginning of the pandemic and today. And that's the main driver of demand. It's how much you have to pay on your monthly mortgage payment every year. And that's gone up because interest rates have gone up and also because home prices have gone up. So that monthly mortgage payment has dropped a little bit in the last 3 months because mortgage rates have come down, although they shot up last week, and because home prices fell in the second half of last year. But again, they're starting to rise. So until that monthly mortgage payment starts coming down, we're not going to see much of a pickup in demand.
How about Europe, Anya? Is it migration, supply shortages, demographics, all of the above driving the housing markets there?
All of the above, indeed. I mean, tying in with what Arlene was saying, there's like the housing shortages in Europe, or most Western European countries, are quite severe. So you have different numbers. But for example, Germany has roughly a housing shortage of about 700,000 homes. The Netherlands is missing about 400,000 homes. A severe shortage. Some countries have housing targets, have had them for years, like the UK has had a pledge to build 300,000 new homes every year. They've never met them. And the reasons for missing these targets and the housing shortage are multiple, but they're quite fundamental and they're not easy to solve, because the key factor here is a general skills shortage and the aging population, because we've got a lot of the construction worker generations that are nearing retirement, and there aren't enough apprentices or just young people wanting to join the trade, which really poses problems for future construction. And of course, the supply shortages are made worse by the population increases triggered by the influx of refugees at the moment into Europe. I'd also say that these housing shortages are going to become more severe in the next few years, not just because we're just missing the people basically to build these houses, but also because of the higher interest rate environment at the moment. So construction costs have just shot up through the roof. We've got high material costs. We've got these labor shortages in the industry that are putting up wage pressures in the industry. It's just like profitability in the construction sector is declining fast. And we can already see in building permits in Europe and housing starts that they have come down a lot from their peaks. It varies a bit by country. Sweden has seen a large correction, but as have France and Germany in terms of new building permits. So overall, we have this period ahead where there's going to be very little housing construction, which already adds to the pressures that we have in the housing market in Europe. That's one of the main reasons why in Europe we think house prices will not fall below their pre-pandemic level, because the supply shortage factor is just so pressing.
You mentioned the labor shortage in construction, so this seems like a good segue into talking about labor markets and the ways that labor markets are impacting housing markets. Anya, let's stay with you. Can you elaborate on what you were talking about there and on the impact of labor markets?
On the one hand, you have this fact that I mentioned earlier, that because we are missing labor in the construction industry, or the construction workforce, we've got fewer people to build new houses. So that's going to support prices in the long term. I think one of the key reasons why prices are also expected to rally is just that labor markets at the moment in general have been very resilient, surprisingly so. And they are the key factor that why house prices might not have fallen as much as we initially expected. So in the first quarter in Europe, for example, in the Eurozone, the unemployment rate was 6.5%, which is well below its pre-pandemic rate, which was over 7%. Vacancies are still very high. They're coming down now, but overall, there's not going to be a massive spike in unemployment, even though we project a slowdown in economic growth in the Eurozone in the coming quarters. And because of that, households staying employed. That gives them a lot more certainty to plan ahead in the future and maybe purchase a house. So again, this is sort of supporting house prices at the moment. The labor market doesn't really solve the overall underlying problem that houses are quite unaffordable in Europe at the moment with the interest rates they are and prices at very high level. But it overall just supports house prices in the longer term.
And Arlene, how are labor markets impacting housing markets in Canada?
Well, Canada's labor market is still very tight. Just in general, we keep adding payrolls, keep expanding. The unemployment rate is just 0.1% higher than the all-time low. We do know, for example, that job vacancies, we want to touch on construction, it's still pretty high. Job vacancies within the construction industries, they peaked last fall at 7.1%. Currently, now it's down to 5.9%. But when you look at the pre-pandemic average, it's much higher because the average was just over 3%. We've seen some improvement, but just not enough improvement to be confident that a lot of this home building spurred by the demand by the Canada's population boost is going to be satisfied anytime too soon. And then obviously with this demand in labor in general, that's going to contribute to building costs. For example, in Canada, labor costs or wage inflation, it peaked at 5.8% just this past November. So it's still pretty recent. We did see that wage inflation slowed about 4.5% in January. The Bank of Canada was pretty confident with that and the fact that overall inflation was beginning to slow. And that's when they first announced that they were going to be pausing their monetary policy tightening. But unfortunately, wage inflation, it's popped back up in February, but it's settled down now to about 5.2% in April. So it's not as good as it was. And then when you have those costs put into new home prices, we see that prices are slowing. They just began to now decline on an annual basis. So new home price inflation just pretty much flat. It was like 0.2%, minus 0.2%. All these things are influencing overall costs. Plus, when you have these higher interest rates, it's contributing to tighter credit conditions for home builders and for new developments to get off and running. And so we think that these new projects were going to be stalled because of this. But eventually, like I said, when our interest rate forecast is going to be coming down next year, there will be greater incentive and greater availability for greater credit available to home developers. More projects will be beginning to rebound after, because home starts, they peaked last year, so they're coming down. They peaked at very high levels and they're coming down from those rates. So eventually we should see some kind of gradual buildup and maintaining housing starts throughout the forecast and not falling off any further.
Patrick, tight labor markets have been a huge theme for the U.S. economy for some time now. How is that intersecting with housing markets there?
Sure, it's tight labor markets, but in the United States, a lot of it is just population shifts. About half the states are losing people to the other half. People are moving from the Northeast, from the Midwest to the South. So about 25 states, I believe, this is a trend that started before the pandemic, accelerated during the pandemic, and is still ongoing. So we're seeing a lot of job growth in the southern states, Texas and Florida, and states like New York and Michigan are losing population. And also California and Washington State, some of the western states, have lost population since the pandemic. People are moving to the south. And so the dynamic there is that we're seeing demand for housing grow in the south, home prices grow, increase in the southern states, and we're seeing home prices drop mostly in the western states, California, Washington, and to some extent, we're seeing less house strength in the Northeast. So it's that dynamic that's at play. And in the short run, it has the effect of driving housing prices up. In the long run, what drives housing prices are construction costs and how hard it is to build homes. And the dynamic there is that it's a lot easier to build in the South because there are fewer restrictions on building. And so if there are fewer restrictions on building over the long run, what happens is that you see more home building, but less growth in prices. The other side to that is that in the West, when there's an increase in demand, you see not much building, but home prices go up. So with people moving from the West, from Washington State to California, to other states, we're seeing home prices go down in those states and home prices rise in the southern states. Eventually, the prices of the South are going to start dropping because it's easier to build there. In the West, we're not going to see much of a drop in home prices because supply is still very restricted there. So to summarize it, the dynamic there is movement across the states, the job growth taking place in some states, and that's driving home prices up in those states. But that rise may not last that long.
So maybe instead of an Italian villa, I should look at a Texas ranch.
You should have looked at one. I think you should have
looked at one last year.
Last year, yes.
If you're interested in Canada, New Brunswick is the place to be.
All right, noted.
Most affordable.
Noted. Maybe our next episode should be property investment tips.
Right.
There you go. So let's talk about how these housing market trends are impacting businesses. How are these housing market trends impacting businesses, and why should our clients care about what we've been talking about today?
In Europe, if you're a commercial real estate company, you have already experienced some of the impacts of the housing market downturn. A lot of commercial real estate companies in Europe have leveraged up aggressively in the past decade, taking advantage of the rising property values and the low interest rate environment. Now they're coming under pressure from the higher interest rates, the funding costs have increased, and the value of their property portfolios has fallen. And concerns have become particularly visible last month in Sweden, where a large landlord had their bonds downgraded, and that triggered a sell-off of bonds of that company, but also other domestic residential and commercial property firms in the country. Sweden, again, is quite vulnerable, not just in the domestic residential market, but also in the commercial real estate market, because debt worth $10 million is going to fall due this year. And 70% of bond issuance of these key players in the Swedish market are a variable rate. So that has raised some financial stability concerns, particularly in Sweden, but overall in Europe. I'd say an overall banking doom loop, all those fears are exaggerated because banks are a lot better capitalized than they were before the global financial crisis. We have much stricter underwriting standards, such as like restrictions on loan to value ratios. There are regular stress tests. And in the Eurozone, most commercial real estate debt is held by larger banks, which are subject to strong oversight, which I think is different in the US, isn't it? I think there's a large portion of commercial real estate debt is like held as commercial mortgage-backed securities, I believe, and held by smaller banks. From a European perspective, like I said, no, I don't expect a big banking doom loop. There's definitely tighter financial conditions, particularly for companies that are in the commercial real estate sectors. I'm more concerned by the impact that falling house property prices have on the overall economic outlook by depressing constructions, as we were talking about. Also, on the consumer side, you have the wealth effect. So previously, as the house prices would go up, consumers' wealth would go up, or like they would be wealthier on paper, which would support consumption. Obviously, that factor is now going in reverse as prices are falling. European households and companies have accumulated a lot of debt in the past decade, and that doesn't go away. It needs to be repaid eventually. So in the medium term, these repayments will just weigh on the economy and particularly the investment outlook in the years to come.
Eileen, how about in Canada? Is there a wealth effect similar to what Anya was just talking about for Canadian homeowners? How might the housing trends that we've been talking about ripple through the economy there?
I want to underscore the fact that, like I said, with the beginning of the turnaround in Canada's existing home market, things are still looking good. For example, consumer confidence, it's been climbing since late last year. And that's while home prices were still diving. So consumers are pretty happy. A large part of that is because we need to put some things into perspectives. In Canada, there was all concerns about, my mortgage payment is going up and all this kind of stuff. And we would hear anecdotal evidence saying I would have to sell my home to be able to afford it. But yet when we look at the hard data, we know that in Canada, the mortgages in arrears is extremely low as a share of total mortgages. It's at 0.15% right now. And that's just off of the absolute low of 0.14%. Canadians, there's going to be no housing crisis, whatever. Plus, the fact that mortgages, when you're applying for a mortgage, you go under extreme stress testing to be able to get a mortgage. Plus, Canada's banking industry is very highly regulated, one of the most highly regulated in the world. Home buyers, they're pretty much doing well. And therefore, you're worried about spending capacity and all this kind of stuff. One concern is some of the GDP numbers that came out. We saw that Canada's savings rate was cut in half. It's now at 2.9%. So people are biting into their savings to accommodate their spending. And we know that credit card debt growth in Canada is also growing. So people are relying more on debt to pay off or to accommodate their spending capacity right now. But the thing is, the way that the system is built in Canada, the number of defaults and everything, that's just not going to be happening there. Given the relatively stable housing market in terms of financing, and the fact that we do have a supply, or the population supply growing, a lot of that's going to be driving a markets in the future after this temporary turn down.
Patrick, how about you bring us home on this question about why these housing trends matter for businesses and the economy at large?
They matter for the economy because housing is a component of the GDP. It's not a very big component, but when it goes up, it can drive GDP. For example, the housing added about 0.5% of growth to GDP last year, which helps a lot because the economy has actually been contracted in 3 of the last 4 quarters. There are 2 ways of measuring growth. One is by measuring GDP, which is the product side, and the other is by looking at the income side. The correct way of measuring growth is to average the 2. And if you average the 2, you find that the economy is actually contracted in 3 of the last 4 quarters. But had it not been for housing, we'd see 4 quarters of contraction. Why should businesses care about housing? It's because their employees live in these houses, and their employees, when they decide to work with that company, one of the key things that the most important thing that they look at is the cost of housing. And so companies either have to locate in places where housing is reasonably affordable for most people, or else, as in the case of Seattle, they have to pay their employees a lot of money to live here. If you live in Seattle or in San Francisco, you can earn a really high salary, but your living standard will be very similar to someone earning 2/3 of your pay living in Texas or Louisiana.
That's another vote for Texas there. But New Brunswick is still on the list, Arlene.
Exactly.
So let's wrap up with some top takeaways for our listeners today. In 30 seconds or less, can you give us one key point that you really want to emphasize?
Sure. So we could talk about housing markets, which is, there really isn't a single housing market. There are thousands of housing markets. I live in the city of Seattle, and Seattle itself has dozens of housing markets where the housing prices in each market is determined by how good the schools are, the crime rate, by how long the commute is. And so when we talk about housing markets, we're generalizing, but it's a cliche, but housing is local. That is a fact. So it's local.
For Canada, most of the worst is behind us right now. We're going to be seeing, eventual upturns in the housing market from population growth. I've even actually increased my housing starts forecast because conditions on which, for home builders and the labor supply, everything's have come off their highly concerned levels. Things are improving, so therefore the outlook for home building will be improving as well.
And Anya?
Well, in Europe, Western European countries are all at different stages of a downturn currently. Overall, we don't expect a particular crash. We just expect a slowdown in prices around the 10% mark on average for the Eurozone, and no return of prices to pre-pandemic levels because the key support to the housing market remains just an absolute big shortage of housing.
Great. Well, thanks again for sharing your insights with us, Patrick, Arlene, and Anya. And thanks to our listeners for tuning in. Join us next week when we will dive deeper into the forces at work in 2023.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.